The role of deflation in the global financial crisis of 2008 and the subsequent policy responses. Introduction. The global financial crisis of 2008 stands as one of the most severe economic downturns since the Great Depression. While many factors contributed to this crisis, deflation played a significant role in exacerbating economic conditions and influencing policy responses. This article delves into the role of deflation during the 2008 crisis and the subsequent measures taken by policymakers to mitigate its effects. Understanding deflation and its impact. Deflation is characterized by a general decline in prices, which can result from decreased demand, excess supply, or tight monetary conditions. During the 2008 financial crisis, deflationary pressures emerged due to the collapse of financial markets, leading to reduced consumer spending and investment. The fear of falling prices further discouraged economic activity, creating a vicious cycle of reduced demand and lower prices. The 2008 financial crisis and deflation. Causes of deflation during the crisis. Collapse of the housing market. The bursting of the housing bubble led to significant declines in home values, resulting in decreased household wealth and spending. Bank failures. Major financial institutions faced insolvency, leading to a credit crunch that restricted access to loans for consumers and businesses. Global trade slowdown. The crisis caused a sharp contraction in global trade, reducing demand for goods and services, reduced consumer confidence. With increasing unemployment and financial instability, consumers cut back on spending, further driving down prices. Effects of deflation. Increased real debt burden. As prices fell, the real value of debt increased, making it more difficult for borrowers to repay loans. Decreased corporate profits. Lower prices squeezed profit margins, leading to layoffs and further economic contraction. Investment decline. Businesses postponed investments due to uncertainty about future demand and falling prices. Wage stagnation. Deflation led to stagnant or declining wages, reducing household income and spending power. Policy responses to combat deflation. Monetary policy measures. Lowering interest rates. Central banks, including the Federal Reserve, slashed interest rates to near zero levels to encourage borrowing and spending. Quantitative easing. QE. Central banks purchased large quantities of government securities and other financial assets to inject liquidity into the economy. Forward guidance. Central banks communicated future policy intentions to influence economic expectations and stabilize markets. Fiscal policy measures. Stimulus packages. Governments implemented massive fiscal stimulus packages, including tax cuts, infrastructure spending, and direct financial aid to households and businesses. Bailouts. Financial institutions deemed too big to fail received bailouts to restore stability and confidence in the financial system. Unemployment benefits. Extended and enhanced unemployment benefits provided a safety net for those affected by the crisis, supporting consumer spending. Long-term implications and lessons learned. The policy responses to the 2008 financial crisis highlight the importance of addressing deflationary pressures promptly and effectively. While the measures taken helped stabilize the economy, they also led to long-term consequences, such as increased public debt and concerns about future inflation. Policymakers continue to study the crisis to develop better tools for managing deflation and preventing future economic downturns. Conclusion. Deflation played a crucial role in deepening the 2008 financial crisis, affecting consumer behavior, investment, and overall economic stability. The subsequent policy responses, involving both monetary and fiscal measures, were essential in mitigating the crisis's impact and restoring economic growth. Understanding the role of deflation and the effectiveness of these policies remains vital for preparing for future financial challenges. FAQ. Question. What is deflation? A. Deflation is a general decline in prices, often caused by reduced demand, excess supply, or tight monetary conditions. Question. How did deflation impact the 2008 financial crisis? A. Deflation increased the real burden of debt, decreased corporate profits, led to investment declines, and caused wage stagnation, further exacerbating the economic downturn. Question. What were some monetary policy responses to combat deflation in 2008? A. Central banks lowered interest rates, implemented quantitative easing, and provided forward guidance to stabilize markets and encourage spending. Question: What were some fiscal policy responses to the 2008 crisis? A. Governments introduced stimulus packages, provided bailouts to key financial institutions, and extended unemployment benefits to support consumer spending. Question: What are the long-term implications of the policy responses to the 2008 crisis? A. The responses helped stabilize the economy but also increased public debt and raised concerns about future inflation, highlighting the need for ongoing evaluation of economic policies.